This is me, and I'm in business, and I sell these things, okay? That thing. And I sell them for 200,000 each, okay? One of them. So over the course of my trading year, I sell 5 of them, okay? 5 of them. So that gets me 1 million in currency in. So my sales are 1 million because I've sold 5 units at 200 each. That's 1 million. And how do we account for this? So I have my sales account, and sales are on the credit side. Bang, 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 there's my sales, and there's 1 million, okay? So let's look at the balance of that. So in the statement of financial position, they're immediately recognized as accounts receivable, okay? Should have written that up here. So they're accounts receivable, okay? It's an asset that we have. We haven't been paid because we sell them on credit. They're very large and it takes a while for it to come back. So what happens next? As customers begin to pay, money goes into our bank account. So on this, we reduce this down. There's an asset balance on this. It's taken down by when people pay. We reduce the amounts that are received because we've received them. And that then goes into our bank account. The asset moves from accounts receivable into our bank account as cash. So that's that side of it. Now let's move on and look at bad debts and how we account for them. So what is a bad debt? It's when someone doesn't pay, okay? So we have some of our goods travel across the world. There's an aeroplane. They fly away from where we are to somewhere else. And this person is in a country that's miles away and just says, I'm just not going to pay you. So how do we account for it? So, but the sales are booked and they go on our income statement, and that helps make up our profit. But so we have sales of 1 million gone under 2024, but what about the bad debts? They reduce the sales because we know this person's not going to pay. So what do? You need to reduce your sales by the 1 million sales by 200,000 that you won't be paid. These brackets are just minus signs, right? So how do we account for it? It goes in as a bad debt expense on the income statement. That's where it goes. That accounts for the fact that this person hasn't paid, okay? That then takes our sales down to 800,000. We've lost this money. So it's an expense. So that's where it's written off to. So we're in business for a couple of years and we're selling some more product here. Now we know, but we don't know for certainty that someone's not going to pay us, right? Some entity is not going to pay us based on past performance. So how do we account for that? And more importantly, why do we account for it? Well, it's to do with the prudence concept. And this is one of the principles of accounting. And the prudence concept says you've just got to err on the side of caution. You have an idea that you won't be paid, so you've got to let people know that you factor that into your accounts. So let's look at how we do that. So we know in our statement of financial position, we have current assets. And these are things that we own, okay? And are to get benefits from in the next 12 months. We have inventory and we have accounts receivable. So we've stuff that we've bought in that we'll sell. We know we'll turn that over. And we've money people owe us. However, this figure has to be reduced by some percentage for the prudence concept and to account for the fact that we know some people won't pay us. So let's see how we do that. So what we do is we apply this percentage. And we have accounts receivable. This is on the statement of financial position under current assets, okay? I'll put down CA for abbreviation, right? And we have our figure of 400,000. We less the bad debts provision of 40 grand, which is 10% of 400. And we get our net accounts receivable figure of 360,000. That's carried on our books. That's what we own at year end. We own that. Now, how does that go to the income statement for the final piece in the puzzle? Well, on our income statement, which is our profit or loss account, we obviously start with sales, which is revenue. We have a load of other expenses, and we have to add in less bad debt provision. because it's going to be a likely cost. And if we're to give a true and fair view of our accounts, then we need to reflect the fact that we're likely not to get paid. And that's likely to be a cost, okay? Now, that mightn't come to pass, but we have to say it. So that's how we account for it.